Thinking investing is all about making quick money. Well, you should think again. Most first time investors lose money not because they don't try, but because they make common mistakes that are totally avoidable. If you are serious about growing your wealth, watch this video till the end because we will be discussing 5 mistakes that beginners make and more importantly, how you can avoid them. Investing is one of the best decisions you can make to grow your wealth, but starting without the right knowledge can cost you dearly. Mistakes like timing the market or blindly following trends could turn your investments into losses. In this video, we will share 5 common mistakes that new investors make and actionable steps to avoid them. Whether you are investing in mutual funds, stocks, or even gold, avoiding these mistakes will set you up for success. So the mistake number 1 that first time investors make is starting without a clear goal. Well, do you know why you are investing? If not, you are already making the first big mistake. Investing without a clear goal is like taking a road trip without a destination. Without a goal, you might end up taking on too much risk or not enough and miss on opportunities. For example, say you invest in high risk stocks when your actual goal is to save for an international family trip in next 2 years. If the market drops, you might not have the money you needed when you need it. Well, now let's talk about the solution to this mistake of not having a clear goal. The solution is simple, is define your financial goals clearly. For short-term goals, the goals that you want to achieve in next 1 to 3 years, like building emergency fund or vacations, use debt funds or FDs. For long-term goals, the goals that you want to accomplish in more than 5 years, like retirement or kids education, use equity-oriented mutual funds or stocks. Having a goal helps you choose the right investments and stay on track. The second mistake that first time investors make is trying to time the market. You might have heard of people waiting for the right time to invest. Well, the truth is that for them, that right time doesn't come. Many beginners think that they can predict market ups and downs. They wait to invest until price falls or pull out their money when prices rise. The problem here is that markets are unpredictable even for experts. For example, let's say you didn't invested in March 2020 because of COVID fears. If you waited for certainty, you would have missed the market's recovery rally. A solution to this mistake is forget timing the market. Instead, focus on time in the market. Start small with SIPs in mutual funds or ETFs. Invest consistently every month regardless of market conditions. Over time, you will benefit from rupee cost averaging and compounding. Third mistake that first time investors make is lack of diversification. Putting all your money in one stock or sector. Well, that's like putting all your eggs in one basket. Many first time investors make the mistake of going all in on a single stock or industry like tech or pharma, thinking it's a sure thing. But if the sector crashes, so does your portfolio. You can avoid making this mistake by diversifying smartly. Allocate funds across asset classes like equity, debt, and gold. Within equity, invest across sectors like IT, banking, FMCG. For beginners, index fund or balanced funds are great options to start with. Diversification reduces risk and ensures one bad investment doesn't derail your financial plan. Now the fourth mistake that first time investors make is following trends or tips blindly. At some point in time, you might have ever acted on a hot tip you saw on social media. You are not alone and it's dangerous. Trending stocks or viral cryptocurrency tokens can feel like easy wins, but they often lead to losses. For example, during the meme stock craze, many investors jumped in without understanding the risk and lost money when the hype faded. The solution to this mistake is do your own research before you invest. Remember, a 30-second Instagram reel won't give you the full picture. Do your homework. Now let's talk about the final mistake, ignoring costs and taxes. If you think taxes and fees don't matter, actually they are quietly eating away your returns. Many beginners focus only on returns and forget about costs like brokerage fees, mutual fund expense ratios, and taxes on your profits. For example, selling a stock within a year means paying short-term capital gains, which is taxed higher than long-term tax rates. The solution to this mistake is use low-cost options like direct mutual funds or discount brokers to reduce fees and your investments to minimize taxes. Understanding costs ensure you keep more of your hard-earned money. Well, these were the common mistakes that first-time investors make. If you want to avoid these mistakes, here are some suggestions to get started the right way. First, start small. Begin with an SIP of 1000 or 2000 just to get comfortable with investing. Second, educate yourself. Follow reliable financial channels or read books and blogs. Third, automate your investments. Set up automated SIPs to invest regularly without emotional interference. Fourth, review but don't overreact. Check your portfolio every 6 months, not daily. Long-term growth is the key. These steps will help you build strong investing habits right from the start. Investing is a journey and making mistakes are part of the learning process. Avoiding these 5 common ones will put you ahead of most first-time investors. So, which of these mistakes have you made or almost made? Let me know in the comments below, and if you found this video helpful, hit that like button, share it with a friend who is starting their investing journey, and subscribe to the channel for more content to help you become the CEO of your financial well-being. Thank you for watching this video till the end. With that said, I will see you in the next video. Till then, keep learning and keep investing.